Imagine having billions in the bank and still not being able to say no. In the next 30 days, Pakistan has to pay $4.8 billion, nearly 30% of its central bank reserves. But here's what the headlines are missing. This isn't a liquidity crisis. This is a control crisis. And the country Pakistan can't pay decides what happens next. Okay, so when a nuclear-armed nation of 260 million people hits a wall like this, it's never just about the money. It's about how global power is being redrawn. While one neighbor builds a fortress of capital, the other is fighting to keep the lights on. And believe me, if you think this is just another bailout story, you haven't been paying attention to who is holding the keys. This is voice on pages. Just let that sink in. Because the shift we're seeing today isn't just about debt. It's about the end of sovereignty, as we knew it. The story comes down to three things: the ultimatum, the 30-year ghost, and the price of control. First, the ultimatum. For decades, the UAE was Pakistan's rich uncle. If money was short, they'd just roll over the deposits. But now, it's like a credit card where the bank suddenly removes the minimum payment option and demands the full balance. Right now, Pakistan owes roughly $3.5 billion to the UAE. And the grace period? It's gone. Just let that sink in. The UAE has shifted from patronage to portfolio discipline. They want returns, not just promises. Interest rates are hitting 6 to 6.5%. That changes the relationship completely. Pakistan is no longer dealing with support, it's dealing with enforcement. And here's the bigger shift most people are missing. This isn't just about Pakistan. This is about how capital behaves globally. For years, countries relied on relationships. Now they're being judged like investments. And once that shift happens, there's no going back. Then there's the $1.3 billion Eurobond repayment, plus a $126 million coupon. Total drain, nearly 29% of reserves. Pakistan has about $16.4 billion in the central bank. But look, after this payment, that cushion is dangerously thin. And here's why that matters. Because markets don't wait for reserves to hit zero. They react the moment confidence starts to crack. Second, the 30-year ghost. And here's the thing that really bites. We're talking about the 30-year ghost. Debt that won't die. Okay, so let's look at something even deeper here. And get this. A $450 million loan taken out in 1996 is finally being repaid in 2026. One-year loans paid across generations. Imagine a one-year loan still being paid by the next generation. That's not a financial strategy. It's a generational burden. And here is the reality we have to face. Logic over loyalty. Capital doesn't care about history. It cares about structure. The entire system is on a life support machine. It requires $12 to $12.5 billion in bilateral deposits just to stay upright. Saudi, UAE, China. Without them, the machine stops. But you know, every time they hit reset, the price goes up. Third, the price of control. So what does this mean for the person on the street? It means the currency loses value while you're holding it. Inflation isn't just a number, it's a thief. It's like borrowing oxygen. Each breath keeps you alive, but it also makes the next breath more expensive. When a country loses control of its wallet, it loses control of its future. And look, this is where the map starts to change. It quietly takes value from your savings, and there's nothing you can do to stop it. Okay, so step back for a second. When multiple countries start facing this kind of pressure at the same time, capital doesn't spread evenly. It concentrates. And right now, you're seeing another layer of pressure. Tensions in the Middle East and the risk of disruption in the Strait of Hormuz. That's nearly 20% of the world's oil supply at risk. And when that kind of uncertainty enters the system, capital doesn't wait. It moves even faster towards stability. It moves away from uncertainty and into the few systems that look stable. Now here's what makes this more dangerous. US-Iran tensions are escalating in the Gulf. Military positioning, sanctions tightening. And the one choke point that controls the flow, the Strait of Hormuz, sits directly in the middle of it. Okay, so here's what that means for Pakistan specifically. Pakistan sources 72% of the crude oil its refineries process from the Middle East. UAE, Saudi Arabia, Qatar, the same three countries it is already financially dependent on. And get this, 99% of its LNG imports come from Qatar and the UAE alone. Just let that sink in. The same relationships being tested by this debt crisis are the ones keeping Pakistan's energy system alive. This isn't just a debt problem sitting next to an energy problem. It's one system, one pressure point. And if Hormuz tightens, even slightly, Pakistan's import bill explodes at exactly the moment its reserves are already 29% drained. There is no strategic buffer here, no sovereign wealth fund, no domestic energy surplus to fall back on. And look, this is what separates a liquidity crisis from a structural crisis. Liquidity problems have solutions. Structural problems have consequences. And look, while all of this is happening to Pakistan, something else entirely is happening next door. While Pakistan is draining its reserves, India is sitting on nearly $697 billion. Just let that sink in. India sees over $50 billion in annual FDI. Pakistan? Just $2.6 billion. Institutional capital is choosing stability over sentiment. India has zero IMF dependency. It is no longer a two-player system in South Asia. One side is playing chess, the other is just trying to find the board. And this is how global capital actually behaves. It doesn't wait for recovery. It moves to where risk is lowest and where control is strongest. That's why India isn't just growing, it's absorbing the capital, leaving weaker systems. In a world where even global oil routes are becoming uncertain, capital is choosing the places where nothing breaks. It's becoming the default destination for capital in the region. The winners? The UAE is earning high returns and gaining massive strategic leverage. The IMF? They're essentially running the budget now. And that leads us to the paradox. A country can have billions in the bank and still not be in control. Scarcity isn't the problem. Freedom is. But here's the real question. Is this just a temporary crisis, or are we witnessing a permanent shift in regional power? And once that freedom is gone, it rarely comes back quickly. Because in the end, capital doesn't have loyalty. It has logic. Steve, signing off.